How should you properly use comparable sales when you're determining how to either buy or sell a house in a real estate market? That's what we're going to discuss today in this video. My name is Adrienne Green. I am a real estate agent here in Chattanooga, Tennessee, as well as a real estate investor working with other investors to help them invest in real estate. And on my channel, I just love to break down helpful information for anything related to real estate. Today, we are going to talk about how you use what we call sales comps or comparable sales when you're looking to either buy or sell a house. So the biggest thing you want to consider is, of course, appreciation. And that's the crazy appreciation, the amazing appreciation we've had in 2020 and 2021 is why this has been really important and why appraisals have been tough, because we've been appreciating so quickly these last 2 years, 15, 20%, that it's been difficult for using an appraisal even a couple months back to account for the fact that houses are now worth more in those 2 months. Now, in 2022, where we are now, we are not anticipating, 15 to 20% into appreciation in the U.S. this year. We are anticipating, depending on your resource and what market you're in, some appreciation this year. Okay. So for the ease of our numbers here today, I'm going to say let's assume the Chattanooga market is going to be getting 10% appreciation for 2022. That would be a significant pullback from what it had been doing relative to, rising interest rates, decreasing demand, and it is still reflective of the fact that Tennessee is the number 7 state in terms of population growth, and Chattanooga is one of the top markets within that state. So we are still having pretty high demand. So we're going to use 10% appreciation as our example here. So if you are looking to buy or sell a house and it was the transaction you're looking at, the comparable sale was 6 months ago, and it was $200,000. Because that was 6 months or half a year, you're going to add half of that as a rough estimate. What we would recommend is you add half of that 10% appreciation. Now, obviously, appreciation is not perfectly linear. We do potentially have some seasonality where it's higher or lower, but this is going to give you a rough idea of where that would be. So if a house sold for $200,000 6 months ago, well, what's 10% of $200,000? It's $20,000. So that means that if a house sold for $200,000 and it was comparable to the house in question that we're evaluating it for, then the house in question would be worth $220,000 today, 6 months later. That is why considering the appreciation when you look at these sales comps is so important, because that is a really notable difference over just 6 months and over a purchase price of $200,000, which is not, it's below our average purchase price. It's not a huge purchase price, okay? So that is what we recommend to clients when they're looking to buy or sell. First, we try to use sales comps that are as close to the date that we are at as in question, but we can't always do that, right? Because sometimes certain types of houses are more unique, and there may not have been a lot of super recent sales. If it's not in a subdivision or an area with a high volume of transactions of very similar houses, sometimes we have to go a little further back, and that's when we really want to just pay attention to what the appreciation has been in the market and what we need to consider in terms of what that sale from 6-9 months ago would be worth today. Even if you were looking at a sale as little as 3 months ago in this example, we would still be adding $10,000, right? Because we would still be adding roughly 2.5% to that sales price from 3 months ago. So it's not insignificant, and it's something that we always recommend people factor in when they are looking to make an offer on a house or to sell a house. So the challenge is if you don't do this, and what you want to consider is if you're making an offer on a house, let's say it's priced at $250 and you're like, is that a fair price? Let's look at sales comps, what it's worth. If you look at a comparable sale of, $220 or $225 roughly from 6 months ago, and you're like, well, this house is only worth $225. You're not taking into account that appreciation. That means that this house is worth $250 now. And you might put in a low offer because you're not using appropriate data, and then you're not going to get the house because you're afraid of overpaying, but in actuality, your offer was low versus what its market value should be. And on the flip side, when you're looking to list a house, listing it at a right price that is appropriate and piques interest while not leaving money on the table is really important as well. So same kind of thing. Let's say that you are the one who's looking to list this house and you saw sales comp from 6 months ago at 225, you would want to consider, well, what has the market done in the last 6 months and how much has it appreciated and what's that 225 house worth today? Because that's closer to where you would want to actually list your house. Now, there are some other factors that go into appropriate pricing and, finding how things are comparable or adjusting for differences between comps, right? But that's not the purpose of today's video. Today's video is what you need to consider in terms of the timeliness of your sales comps and how to adjust them. So we can do more videos about sales comps if you're interested. I'd love for you to post your questions in the comments. I'd be happy to answer them in future videos. And as always, if this is helpful or you'd like more videos about buying, selling, investing in real estate, please thumbs up the video and subscribe to the channel. Adrienne Green here. Thank you so much and have a great day.